introduce myself. My name is Gaynor Dykes. I work for GrowthAccelerator, one of the sponsors for today and of this afternoon's session. GrowthAccelerator is a service that's here to help growth ambitious companies, and we'll explain that to you in a bit more detail further on this afternoon. The aim of this afternoon's session is to help you think more creatively about how you can finance your business and the innovative ideas that you have. We're privileged to have a fantastic mix of speakers with us this afternoon from both established and new providers of finance, all experts in their field, all helping companies to raise the finance that they need. The quest for economic growth has been the focus of the past 5 years, and thankfully we're starting to see the beginnings of the country's rise out of recession. It's widely recognised that in order for the economy to continue to recover, we have to have business growth. We also know that high-growth businesses play a vital role, and having access to finance for these businesses is often critical. So there has to be finance to back entrepreneurs and finance to allow businesses to grow. The type of finance available matters too. Different finance products suit different businesses, dependent upon their maturity and their risk profile. Debt finance in the UK has been dominated by a relatively small number of banks, but with the onerous task set before the banks of improving their balance sheets and ensuring lending is made responsibly to protect public assets, whilst also trying to achieve lending targets set, banks seem to be somewhere between a rock and a hard place. Banks need to lend. It's part of how they generate their income, and they do lend, as we'll hear from Alan later. But with the changing economy, they need to make lending assessments carefully and take as little risk as possible. But banks are not the only lenders, and increasing competition among providers of finance can be beneficial, encouraging innovation and better offers. Changes in markets drives innovation, and this is what we've seen happening amongst funders in recent years. New innovative funding providers of both debt and equity have emerged, offering alternative ways to finance your business, often complementary to traditional sources, and providing finance alongside the banks and other providers. This slide shows the traditional way of funding a business, from concept stage through to growth and maturity. So as you can see, at concept stage and pre-production or pre-revenue, often a business will finance through the founder's own money, through family, friends investment, often through grants. We heard from the Technology Strategy Board this morning and the offer that they can make. Business angels play a key part at that stage too. As a company moves into revenue generation, then they can demonstrate they can service debt, and debt funding can come into play. And as they reach growth and they can demonstrate returns to venture capital funds and private equity funds, then that's where their funding can come into use as well. Traditional funding providers and products, such as you see here, are all still active in the market. Some of the alternative funders have adapted and changed their offer to bridge that finance gap, providing risk capital by way of grants, loans, and venture capital. And over recent years, these are some of the newer finance products that have emerged. And these are some of the ones that we're going to hear about today.
We're a growth company, we're an innovative company, and yes, we are a finance company. We've also been recognised as one of the most important growth companies, up-and-coming growth companies within the UK. The proposition for SMEs is basically it's a pay-as-you-go working capital solution. So we're actually an online platform where companies put on specific invoices, and we have a series of investors that effectively finance those invoices at the rate that is determined by the SME. It's very flexible. You only pay for it if you need to use it, so we don't lock you into contracts. It's not something that you're required to use, and it's very, very quick. Indeed, we can get you on board within 48 hours. Indeed, I have one company on board on Monday of last week, and they were trading by Friday. So that's pretty quick in the grand scale of things. Just a few facts. This is slightly out of date, actually, because it says that 22 million has been traded over the platform in the last 14 months. Actually, it's more about 24 million. I was myself on Friday in the office till very late, putting about £750,000 worth of invoices on the system. So, the growth rate is phenomenal. We have about 450 members. We're trading around 4 or 5 million a month, and that's growing literally week on week. As I'm finding out by the hours that I'm working. Invoices, as I mentioned, the upper limit, there is no upper limit. We've had the largest invoice of £500,000, and also much smaller invoices of as low as 4,000, 5,000, absolutely fine. When it gets below there, it's a little bit less cost effective, but companies can also aggregate invoices together to increase the overall value, thus making it more cost effective. Every single company that has come to us and every single invoice that every single invoice that has been put on the platform has been fully funded. That's 100% success rate. So every single company has been successful in getting their funds. And I think that's a very, very good track record. So we're very careful about the companies that we let on. We obviously want to make sure we've got good quality companies that are coming on board with good quality invoices they're putting up on the system for the assurance and the security for the investors. So basically, if you're a business and you sell to other businesses, you've got invoices in the thousands, as I've just mentioned, to make it cost effective. And sometimes you feel that you do need working capital, not just because you want to get rid of your overdraft, but potentially you've got that all-important project that's coming on board, or you want to hire somebody else, or it could just be that you've had a cracking year and HMRC comes knocking at the door, then possibly we could help. You basically call the shots. And it's access pay-as-you-go working capital, which basically means if you don't use us, then you are not going to pay for us. And that is Platform Black.
So what's our vision? To transform and dominate the seed equity finance market on a global basis. You can see there that a number of our advocates, the Bank of England and Forbes, think we're pretty well placed to do so. So I'm not going to go into too much depth about this problem itself. I suspect a lot of you guys understand the finance sector and the issues that there are in there. What I will say is that this whole idea, this whole concept of equity crowdfunding was born from the founders' frustrations at trying to raise startup and early stage finance themselves. In essence, what they're trying to do is bridge the funding gap between the banks and the VCs and the angels, and I suppose thus a crowd of smaller investors was born. So, how do we do this? What's our solution? The best way that I've found to describe this, and I will always sort of use this analogy when I'm talking to new people, is that it's similar to the premise of Dragon's Den. Instead of our entrepreneurs pitching to Peter Jones or Duncan Ballantyne, they pitch online to our investor member base of 44,000, our armchair dragons. So we're actually the world's first and leading equity crowdfunding platform. And for about 9 months now, we've been authorized and regulated by the Financial Conduct Authority. Okay, so what we've got here is a very basic pitch. This is Cam & Sons. They funded probably 6 months ago on CrowdCube. You might actually notice the entrepreneur. That's Alex Cameling. He's now the face of the Smirnoff advert, but this was for his own business. Okay, so what you've got here, this is, I suppose, the primary point of engagement between the investor and the entrepreneur. You've got a video pitch, which is a really great way to create a human side to the business for the entrepreneur to convey their personality as well as their business model and the facts and figures that you get on that pitch. You've also got there an executive summary, a little bit of information about the pitch, a potential exit strategy, some information on the entrepreneur and the team, which is very important on our platform, and then finally some documents. So you've got a business plan and 3-year financial forecasts. On the right-hand side there, you can see we've got the investment target, 325,000, 20% equity offered. You've got the amount of investors and the number that's been invested thus far. It's very easy to share and integratable with social media. So we have all this functionality for you. We've got the Twitter, LinkedIn, messaging. We've got widgets that you can add onto the site. We've got Facebook. Everything's made very simple for you. I think quite important and an imperative and an interesting element of crowdfunding and CrowdCube is that Q&A. So you can see just under the branding there. This is where our entrepreneurs and our investors and investors amongst themselves really discuss the pitch, discuss the merits, the downfalls, potential market trends, sectoral trends. It's a really fantastic way of really enhancing the due diligence of the business. I think finally, worth mentioning on this pitch is how easy it is to invest. It's simply a case of setting up with our payment provider, Go Cardless, and putting in that amount. Now, I'm not going to go into too much detail about this either, but what I would say is our website, the whole platform, is designed to be simple and intuitive for the investors and the entrepreneurs. Our real focus is to put these entrepreneurs in control. I think this is really born from our pragmatic attitude as entrepreneurs ourselves and understanding the real problems. Now, this is the most exciting aspect of the business for me, and I suppose really why I got involved in it. The way that crowdfunding and equity crowdfunding democratizes the investment process. So, yeah, it's open to angel investors, and we've got around sort of 8,000 self-cert high net worths on the site now, but it's also making this whole investment process accessible to a different demographic, those that previously weren't able to invest. It's almost sort of a non-elitist way of investing, and I think that's a really interesting and a really important concept in equity crowdfunding. Now, finally, we don't charge any investment fees, either upfront or at exit. Our sort of motto on this is their money, their risk, their reward. The market itself, these figures are a little bit out of date. 2009 was when this research was done. What it's worth taking from this slide is that we're making a real impact on the angel market. You can see there the impetus we're having. And I think we're really poised to, I suppose, take more of this market share in the coming years off angel platforms and with angel platforms, and also in the VC space as well. So let me put it all into context a little bit. In the last 2 years, we've now raised £12 million from 64 successfully funded deals, with a largest raise of £1.5 million, although I think that's not too far away from being topped by Kevin MacLeod from Grand Designs is just completing a raise with Hab Housing, his architecture company. The average raise on the site, though, worth mentioning, is about 170,000. Now, we've got 44,000 members on the site, of which I sort of hinted at earlier. 8,000 of those are self-cert high net worths. Quite interestingly, this makes us one of the larger angel networks in the UK, as well as being an equity crowdfunding platform. Now, the average investment on the site, 2,750. The largest single investment we've had was 250,000, although we've had 10 investments of over £100,000. You can see there's a pretty similar growth stage spread. So there's a slight bias towards the early stage and growth companies. Those are revenue producing and or profit producing. But we've funded startups in the sector. We've funded a large number of startups, those that perhaps tick the 3 boxes that we're looking for, which I'll come on to in a second. In terms of categories that excel, we do have some sectors that excel on CrowdCube. I suppose vertical markets, should you want to call them that. Retail and food and drink. Now, these, I think, are popular because of the tangible nature of these businesses. They're very easy to understand, very easy to engage with. For example, you can go into Waitrose and buy some righteous salad dressing. You can go into Soho and buy green and pleasant lager. They offer the option of creating, I suppose, the propensity to create that emotional connection between investor and entrepreneur. Now, internet and tech, another good market for us, another vertical of ours. And I think the reason for this is because they can be disruptive. These types of businesses really solve age-old problems. As a result, there's a propensity to scale very rapidly and offer a significant return on investment. Now, you can see, though, we've funded anything from sport, leisure, media, oil and gas, education. There's a whole array of businesses that we've funded in there. There's 3 key points that our investors are looking for. And we have pulled this together by analysing our own businesses, talking to our investors, and also with some pretty extensive research conducted with the London School of Economics. Now, these 3 key investable characteristics are a strong entrepreneur, a strong management team that have those skills, the experience, the drive, the passion to really progress that business towards its aims and hit those goals. Number 2 is real market potential, be that in a niche market or a growth market. There needs to be market potential. And the third, probably more relevant characteristic to CrowdCube and equity crowdfunding is an idea that moves the investors. So be that an emotional connection or a practical connection, that idea and that engagement with the business is really key. Okay, so I'm quickly going to go through a couple of case studies. These are some of our, I suppose, hallmark pitches, some of the early ones that have funded and really uncovered the trends for us. So what you've got there is the Rushmore Group. They're a London members club. Milk and Honey in Soho is one of their bigger clubs. Up until relatively recently, they were one of our biggest raisers with $1 million. They did that from 143 investors in 32 days at an average investment size of 6,700. Now, Jem Misa and Righteous Salad Dressings, she's actually come back for a second round and raised £150,000 in that one. But in this first round, she raised $75,000 from 82 investors in 37 days with an average investment size of £900. Now, Escape the City is one of my favorite examples. This is Dom and Rob, two very innovative and creative entrepreneurs. They actually had that full £600,000 on the table from two venture capitalists. And they turned down those deals to come and pitch on CrowdCube. They were able to mobilize their member base and raise that £600,000 from 394 investors in 14 days at an average investment size of 1,400. It's a really interesting, engaging, accessible, and exciting new way of raising finance with a UK-wide investor reach. I suppose the ancillary benefit of that is the marketing effect. You're not only projecting and pitching your business to over 44,000 investors, but these guys could be potential customers, and a lot of our entrepreneurs do end up with a much larger customer base at the end of their round. Being an online platform, we're very easy to promote, and it's cost-effective as well. We think it's very fair. We are success-based, and we will take 5% of the investment target. I suppose my final point is this crowd feedback, and it's very relevant to the platform. Even for those businesses that don't fund, there's a fantastic chance to really test your business model amongst some very seasoned professional investors and some of those that perhaps just have good ideas. So I think it's a fantastic way of working out whether your business works. If you fund, fantastic, progressing and moving on forwards. If not, taking stock of what other people are thinking and progressing it anyway.
Part of the remit I was given was talking a bit about angels, and I think there is a lot of information about and statistics about SEIS and EIS, and I'm going to give you some very broad themes, but to be totally honest, the best thing you can do is go to the HMRC website and read the detail, and then after you've done that, go and see your local accountant or lawyer, because they're both actually very technical schemes, and there's an awful lot of things that you ought to know about and take advice on, because there are a lot of interesting poo traps. Some of the advantages aren't quite as easily had as it might appear from the headline figures that you might see on a slide. One of the main things is women angels and men angels have different attitudes, and younger angels might have different attitudes and different investing styles to older angels physically in terms of their behavior. But the truth is that all angels have one common objective and often a second one. What do you think those two objectives are? Make money. Anything else? No, okay, there's actually another really important objective. If you just wanted to make money, you would be arguably better off just putting your money in the stock market. The FTSE's done really well over the last 2 to 3 years. They also do it to give back and add value. And that's a really important part of angel investing, is that it's not just about the making money bit. Now, there's a good reason for having that motive, in that roughly 54 to 56% of angel investments will fail to give their investors the money back. They really like investing in really sexy stuff. And one of the biggest issues is, even if you've got a really great business, is making sure you present it, that it looks really cool. And I'm talking about all these things before we talk about the tax breaks, because the tax breaks really must be not be the tail that wags the dog. And I'll explain why in a minute. So if you want to raise money off angels, you really want to be thinking, Well, the person they met before is probably some 3-year-old who's developed an app which is about to be worth £45 billion. And the next person's got a sort of almost risk-free property portfolio with a clever tax dodge deal yielding 8% a year tax-free. You know, you've got to be able to position yourself and make yourself look cool. In the industry, we talk about smart money and dumb money. Now, that's not about the intelligence of the investor. That's about how smart that money is for you. That you really do want their value add an angel can bring, their industry experience, their contacts, their willingness to give you time. A good angel will never charge you for their time. That doesn't mean if they're working full-time for you, you shouldn't come to some sensible grown-up arrangement because you're all adults. But it shouldn't be sort of buying an investment for a job, but they should be working with you and helping you on your way, certainly intermittently. Or if they're passive, you need to be thinking, how am I going to access that value added that these people can bring? Don't tend to like films. They do like things which have relatively low costs to get to a profitable state. One of the reasons they're nervous of things that need an awful lot of money to get to profitability is because it will need more and more funding, and they may not have the capacity to fund. And if other people start investing, what happens is the angel tends to get diluted, and their chance of making loads of money diminishes. So again, when you're looking at doing a fundraising with angels, really try and think not just today's money and that will get me through the next year. Try and say, what's the long-term picture? And you and me, the entrepreneur, you, the angel, how are we going to get an exit where we have both sail off in our yachts into the sunset together? EIS and SEIS. And actually, there's a new one coming out, you'll be delighted to hear, called the Social Enterprise Investment Scheme, which is due to launch in April. And we were just with the Treasury earlier this week discussing all the nuances of if it's a social enterprise, how do you give it a tax break and the issues. But broadly speaking, the reason the government does these tax breaks is partly because of historically there is a philosophy of a belief that there's a gap in amount of money available for enterprise to help it grow. So that's one of the key tenets. Another thing is it's a great way of bringing great businesses into the country. Did you know that Skype was an EIS-backed company? What was it, Estonians in somewhere else or whatever, you know. So there's an awful lot of flexibility for companies. As long as you've got a domicile of some description in this country, some sort of trading office or a head office, you do not legally need to be a British company to get EIS or SEIS. So it's a great way of generating investment in enterprise. It is the most generous tax break. These tax break schemes are the most generous in the world. If you have some money to invest that you can afford to lose, and you're prepared not to be completely lazy and just give it to someone else to burn, you should definitely look into whether investing is good for you. Because you basically, with EIS, you can invest £1 million a year, and you'll get a 30% income tax break. If you've got some capital gains that you're due to pay, you can roll those into the EIS and basically defer them in perpetuity. And if that deal comes good and you make a lot of money, you get all that capital gains tax-free. If that deal goes bust, the government actually writes you a cheque for some of the money you've lost to say, I'm terribly sorry you've lost your money. You don't get the whole lot back. So that's £1 million a year. SEIS is even more phenomenal. For that, there are restrictions. You have to invest in younger companies and they have to be smaller and things like that. But it's basically, you can put 100,000 as an investor, you get a 50% income tax break. You can do this in addition to EIS. You also get your loss reliefs and your capital gains rollovers and everything. So if you can get into the right company early, and you can actually find yourself, hardly paying for it. And actually the way the capital gains tax and loss relief has worked, I think there's still a little bit of time where basically if you invest soon using last year's capital gains and it all goes wrong, actually the government pays you 100.5% back in tax breaks. So you actually make money off the government if the deal goes bust. So anyone who has to pay ordinary tax might wish to quibble that their taxes are being delivered in this way, but that is the truth. The big thing to remember is that you do not get tax relief on dividends. This is really important for entrepreneurs because depending on the sort of business you're creating, basically, this is all about investing the money for capital growth. You have to hold the shares for 3 years. If you, as the entrepreneur, are so successful you sell in 2 years, what happens is you walk away laughing. The entrepreneur will actually, the taxman will ring up and say, well, sorry, you've broken the rules. We're clawing your reliefs back. So there are all sorts of little wrinkles about, you can be almost too successful for the scheme from an investor point of view, which may be different from the commercial imperative of the company. So there's lots and lots of little wrinkles, but broadly speaking, you don't get tax-free dividends. So that means the companies do not pay dividends. They roll up everything, waiting for the big capital gain at the end, when they can scoop the whole lot capital gains tax-free. You can invest up to £5 million in a company. You can now do rather large companies. I think we're 250 employees still technically counts. So all this sort of investing in just a tiddler startup, no, it doesn't have to be like that. But you can't invest in certain sectors. The government has spotted that investing in farmland is not really very entrepreneurial. They don't like hotels, but they're a bit more relaxed about things like childcare nurseries, which happen to buy the property that they run the nursery out of, but that's different somehow. So there's all sorts of neat little wrinkles and rules. And the thing also to remember when you're investing or as an entrepreneur is that the operational activities of the company can cause your investor to lose the reliefs. If you suddenly shot up to 1,000 employees in 2 years, the investors would lose their relief. So you do get some occasions when investors actually force a sale of the company early because it would not be worth hanging on for the bigger reward because they'd lose the tax breaks. So that's why I say very much, don't look at the detailed numbers at the moment, decide if it's something that's for you, and go and talk to an accountant or a lawyer who specialises in these things. SEIS, the big difference is the company has to be trading for less than 2 years. By trading, they don't mean incorporating the company. It's a sense of when was the date the business started, that particular business. You can't do, unfortunately, things like be a running business, have a new idea for what would normally be a new division, and just hive it out and say, oh, that's a brand new company, it's an EIS one. It's all about things called connected parties. There are all sorts of other weird rules as well about who's allowed to use EIS and who isn't. So if your dad wants to invest in your company, he cannot have EIS for making that investment because the government deems that dad would have done it anyway. So for those of you with rich, close relatives, sorry, that's not going to be the way to get them to write checks to you. And broadly speaking, about 600 or 700 million pounds a year is invested in EIS. The top upper limit is, as I said, £1 million a year. That's probably 200, 300, 400 people a year are investing £1 million. Maybe it's more like 100 people are investing £1 million a year now. So there's an increasing trend towards people making bigger and bigger investments in bigger companies, in more volume. It did dip badly in the credit crunch, but we're now seeing the kick up again coming. CDIS, it's in its first year. It's done about 52 million of investment in the first year, about 350 companies. So it's about 10% of the size of EIS. And then lastly, we've got this new social enterprise investment relief, which is planned to be like EIS. You'll be able to invest perhaps up to £1 million. You might be able to have a 30% income tax break. And the crucial difference there is they're thinking about allowing that if you lend to, say, a charity or some sort of community interest company, you'll be able to get tax relief on the capital you lend to that company. That's a really big point because in EIS and SEIS, one of the big things is you're not allowed to lend to the company and get a tax break. That's perceived as not allowed. Really simple reason. The government does it because it makes the taxman loads of money. It keeps us all happy because we all get jobs and people feel entrepreneurial and work hard and that's all fun and you get to back great companies. But also, basically what happens is instead of trying to collect capital gains tax from rich people, which rich people are very good at making sure they are sensible about how they manage their tax affairs, they basically take that money from being a capital gains tax, difficult to collect tax, into being cash in a company. And most companies these days, actually, they spend the money on employing people. And the minute somebody's employed in a company, you can tell where they are. You've got PAYE coming in, you've got NI, you've got VAT, you've got corporation tax. The government makes something like 30% of what it loses back within 12 months. And as long as enough of those companies survive 2, 3, 4 years, they're making a positive return on their money. So actually, it is good for the taxpayer. Thank you very much.
So I'm going to talk briefly on this slide. We've got the main three aspects of funding solution for a small SME is asset finance, and I'll just talk briefly on later on about asset finance, loans and overdrafts, very basic stuff that we'll all know about, and invoice finance. And for me, invoice finance is a fantastic product for growth businesses. Some people still consider it costly, and some people also consider it's the lend of last resort. I don't see it like that. I think if invoice finance is the lend of last resort, then that potentially means to me that they've come in too late if a business is struggling. So the big $1 million, it's probably $1 billion question, are the banks lending? And what are we doing to help growth in the economy? Well, there's two fundamental things that I'd like to share with you. One is that the NatWest and the RBS Group support the Enterprise Finance Guarantee Scheme wholeheartedly, in that we, in total there's 40 providers that cover the Enterprise Finance Guarantee Scheme, and we cover 40% of the total funding within that scheme. The other thing that is really, really important and a huge boost to the economy is the government's funding for lending scheme, and we've put aside $2.5 billion to help SMEs access cheaper funding. And to date, that's 21,000 SMEs have benefited by that, and £70 million worth of money saved in interest and fees. So again, I've briefly mentioned funding for lending, and I don't have a slide on this next point that I'm going to make, because it's one of these things that we don't advertise publicly, but we do still have, following a £70 million pot of funds from regional growth that was utilised throughout 2012, we do now have a £25 million pot of grant funding available. It's there on a first come, first served basis, but it does help businesses where there is a lack of deposit for an asset purchase, where it will also include job creation. And it is a non-repayable grant subject to a couple of caveats. So that is a huge opportunity for us to lend more money, but make sure that we do so in a responsible way, but through the assistance of regional growth, which is brilliant. The other thing that I just wanted to touch on as well was what makes a good proposition? What does good really, really look like? Above all else, I think it's really, really important for banks to identify what a customer really, really wants. This isn't a guessing game. This is really about getting under the skin of what the customer needs. And the communication and the relationship between ourselves as bankers and our customers is absolutely critical. What do I like to see? Well, I like to see a good quality business plan, but in terms of what's really important to me in a business plan is, do the maths add up? So if it's a startup proposition, I really need to understand why something is going to generate a certain level of revenue and create a certain level of profit on a fixed cost base that ultimately is going to repay the bank. And I think as an old school bank that's been around quite some time, I think the really key point is very much up to the customer to try and demonstrate to the bank how they repay the bank's debt. But what's also critical is how we help the customer demonstrate that they can repay the bank's debt as well. Financial information. I think more than ever before, there is a huge need for customers to provide us with current financial information. And I think even on projection basis, cash flows as well, and particularly cash flows that have got to be really realistic. And the other point for me is there's got to be a plan B. What happens if something doesn't go according to plan? Finally, a couple more really, really important points for me. Cash contribution. Bank statements that demonstrate financial control. Cash contribution in particular needs to reflect the level of risk, and we will price that accordingly. A good starting point for us is the background to the clients in terms of background assets and in terms of their own present debt position. That's critical as well. And another really, really big point, and when we see things go wrong, this can really be quite a tangible one, is experience. Experience and transferable skills is a huge one. And if we see all that, I'll be working for a Carlsberg bank. So it's always about a balance of strength and weakness and getting that balance right. So what are your funding options? And I think we'll all recognise some of the basics here. Business overdrafts. There's been mention of banks pulling overdrafts. I think one of the things that I observe in the overdraft space at the moment, there's an awful lot of historic overdrafts that are not appropriate for the needs of that business. A business, for me, the definition of an overdraft is temporary and occasional use. And that should swing in and out of credit. And there is a brilliant working capital optimizer, we call it, on our NatWest website at the moment, where if you put in your debtors, your creditors, your stock, you can actually see what your funding gap is. Notwithstanding a working capital optimizer, you need a decent cash flow to demonstrate what an overdraft need is. Typically with fees annually, and you'll pay interest on utilisation. Other funding options, longer term borrowing, so we'll do loans for virtually any purpose, typically up to 25-year terms, and we'll utilise the funding for lending scheme to make it as cheap as we possibly can. But we'll make those loans bespoke as well, and there are a few bells and whistles that we can attach to it to make it easy for the client. The last two slides I just want to share with you are firstly about asset finance. So the Royal Bank of Scotland Group owns a company called Lombard. It's been around a long, long time. And asset finance, for me, is critical. What I would say about asset finance is, if I was a customer, I would utilise the need for asset finance above unsecured borrowing from a bank, because there's always a certain level where unsecured borrowing gets to, where you think that's just now getting too much now. So for me, I would always go down the asset finance route before I would go down conventional bank funding route. Now, there's not enough on these slides to tell you what Lombard can offer, but they offer tailored solutions to help purchase machinery, technology, business equipment and furnishings. And some of the core products typically will involve purchase agreements and lease agreements. But you will start with low deposits. There is RGF eligibility on Lombard products as well, and the asset typically will be the security. And finally, invoice finance. Now again, I think invoice finance is a fantastic product for growing businesses. What's really important is that, there are two streams. One stream is you can go down the factoring route. One stream is you can go down the invoice discounting route. The difference between the two is that from the factoring perspective, the customer will have his debtors collected for him by the invoice finance company. And on the invoice discounting route, that can be confidential and the debtors are collected by the customer. But what's really good about it is if you've got £100,000 worth of debtors, you could raise up to £85,000 in one lump sum. And in doing so, you can improve your working capital cycle. There are costs involved, so you'll be charged interest on obviously the drawdown of the facility, and there are fees involved in drawing the facility down as well, so it's perceived slightly more expensive. But one thought I would leave you with is, what is the benefit to the company in following this route? Because there are huge benefits to be expanding at a certain rate and using invoice discounting over and above conventional funding such as loans and overdrafts that may require assets such as houses as security. That is typically not what's involved with invoice discounting.
It is a service, it's a government-backed service, and it's there to support businesses that are ambitious, and we provide a wraparound support to them to help them on their growth journey. You can see from this slide, the businesses are at the centre of everything we do, We provide one-to-one coaching for those companies on whatever is their specific challenge or hurdle or obstacle to growth to help them along that path a lot quicker and a lot more successfully. We have a team of growth managers that work alongside those businesses and alongside the coaches that we appoint. We supplement that by giving access to workshops, to masterclasses, and also access to grant funding to help pay towards training the management team. The Growth Accelerator service, the needs of the clients that come into Growth Accelerator are typically in accessing finance. They need help in that area. They need help in business development, which is very generic, can include strategy, marketing, operations, recruitment, or it can be about innovation and becoming more innovative. We often start off the service with one of our tools called Growth Mapper, and this asks 100 questions of you as a business owner about your company. So it provides a report with the responses from those questions, your views, your team's views about your organisation, and up to 6 people within a company can go through that exercise and answer those 100 questions. It's all done online, it's very, very quick, but it summarises the results in different formats, and this is just one example of how the results can be shown. So in this slide, if you can see the 3 colours, they're 3 individual responses to the 100 questions, and you can see whoever was the colour green thought they were very strong in strategy as an organisation, but individual pink thought they were particularly weak. So the management team are not aligned, and that helps us to start the debate and discussion about how this company can achieve its growth with difference of opinions in different areas and the views of the company. So that can be a starting point for us. As this session is about finance, if the access to finance support through Growth Accelerator is very much about bringing into the company some professional finance resource in the form of a coach to help that company increase its chances of raising the finance it needs. So it's support to become investment ready and everything that accompanies that, or finance ready, understanding how much finance they need, what the different options are regarding finance products. And you've heard today from a number of speakers, and there's obviously a plethora of funding options out there, but it's quite difficult to understand which ones are right for you as an organisation and how you go about it and how you prepare yourself to do that. So our coaches support that process, engage the companies in that investment readiness service, and then introduce them to appropriate funders as well. The Growth Accelerator is only for small, medium-sized enterprises. It's available for start-up companies right through to organisations that employ up to 250 employees and turn over up to £40 million. You do have to be registered in England, but it can be any sector, any age of organisation. And the benefit's really that you can start off with that impartial diagnosis, get the views from your management team, you get the additional resource in the coach that comes to work alongside your organisation, you get the introductions to finance providers, and we help you to develop your management team to support your growth. And that, in a nutshell, is Growth Accelerator. There is a cost to companies coming onto the programme, as described on there. So just to sort of finalise, particularly on what we've heard on funding, just some top 10 tips, really. The funding landscape has changed. It does call for a new approach. You shouldn't just rely on the traditional sources. The policies may have changed. The sectors that they can and cannot support will change as well and evolve. You really need to define your funding requirement carefully. You need to know exactly what is required and what it's going to be used for. You need then to consider which funders match that requirement and make sure that you present a credible, robust business plan to whichever funder you go in front of. Market the plan to those funders, but explore the alternatives as well. Sell your plan to other sources of finance. You must prepare for due diligence. Any lender, any investor is going to look carefully at your business before they part with their money. So make sure you've got answers to all the questions that they're going to ask, because they will ask them. And have a plan B. If the first funder you speak to can't help, have a plan B of who you can approach next. If you're not successful the first time you apply for funding, have a look at your model. Is it scalable? Do you need that much money to start with? Can you scale up? And really have a close look at where you go from there. And finally, do take advice, do seek support. There's some excellent services out there course Growth Accelerator included, but you can take advice and really improve your chances of getting the finance that you need.